All right, what is going on, guys? Welcome to Trading Academy Day 8. So in today's video, we're going to be talking about draw on liquidity, right? If you guys haven't seen the intro to liquidity video that I posted on Saturday of last week, go and watch that video. Get familiar with the liquidity. What is liquidity? Stuff like that. Get familiar with that, and then come back and watch this video. And if you didn't do the homework, get your ass on the charts and do the fucking homework. All right, go watch that video. Do the homework. Do as I said in that video, so that way you can come and watch this video, and everything's gonna make a lot more sense. All right. So now we're going to get into more of a progression, right? Because we're trying to speed through this so that way we can get into the more advanced stuff. But this should not be hard at all. Okay. I gave you guys one solid week of simple explanations on really everything you really need to know. Again, if you have any questions, go back on the Sunday homework video and comment whatever questions you guys have thus far. Okay. Because on drawing liquidity video, this is not going to make sense if you guys haven't seen the first week or even the last video on the intro to liquidity. Okay. Basically, drawing liquidity is just going to be you have these swing points, right, where your liquidity is at. And then you've seen in that intro liquidity video where price will take out a high and then it'll reverse to go to these other points of liquidity. That's basically drawing liquidity. It's basically like trying to figure out where price wants to draw to and which liquidity it wants to attack next. Okay. And the key to that is going to be displacement in the candles. And we'll talk about that in tomorrow's video. But for example, like when we have this price leg start moving up, the most likely area on where price is going to go next is this swing high, which is where stops are resting, right? This is where price is going to want to draw up to next to attack. Okay, it's going to attack that high. It's going to take those stops. It's going to take traders out, get traders in, and then once we see this price like coming back down into this range, we can assume that the draw on liquidity is going to be this low and this low potentially next, right? And price leg comes down, it takes out that. And then once we push up, we can assume that this one up here, this new one, right? This new swing high that took out this one is going to be the draw on liquidity next. And then we have a price leg back down, make a higher low, and then we push up to attack that high. Okay, that's basically what draw on liquidity is. It's just trying to find out where the market is most likely going to go next. Now, I already drew up this little example over here. So if we just come back and back test this area right here, you guys have very clear swing points, right? Price has already took all these lows, right? Price has already taken all these lows, right? Equal lows, swing low, swing low. Price has already taken all these lows, right? Now, where do you think price is going to go next, right? It's gearing up for a leg up, right? So we have to identify all our liquidity points, right? So this is a swing high, this is a swing high, this is a swing high. These are swing highs right here. Now, price obviously goes up, right? You guys just seen it. It attacks that liquidity, right? After sweeping all this liquidity over here, boom, all these lows, takes it all out, and now we start pushing up, right? I'll give you guys a sneak peek of tomorrow's video, right? It's going to be displacement. Why displacement is key. Displacement meaning a very large candle, right? Like this one. It's rushing up to draw onto this liquidity point, this swing high right here. That's where price is most likely going to go. When you see big candles like this heading up to a swing high, that's where your draw on liquidity, your DOL is going to be. Okay. So it attacks that. So your next one is going to be okay. So we're in a bullish trend now, right? We've broken structure, we've closed above. So do we come down and make a higher low to continue the trend up for our next draw on liquidity, our next swing high? Our next swing high is up here. Well, let's see, right? Come up, come up, come up, come up. Boom, right? We attack the next high. Okay, draw on liquidity is just think of it as like a magnet of these old swing highs and old swing lows. That's all draw on liquidity is. You are figuring out where price is most likely going to go, where price is most likely going to draw to with displacement in these candles, meaning the speed of these candles that are going like way up, right? That's how you're going to figure out draw on liquidity. Very easy. It's just looking at these candles, looking at what they do. If they're closing big bodies like this, and it looks like it's closing like with speed, like for example, these three candles, they're pushing up very, very fast, right? So our next draw on liquidity we can assume is right here. Our job is to figure out where can we get in on this, right? If we start zooming in, we can find entries, but that's, again, it's going to be for another video. This video is just drawing liquidity. I don't want to get ahead of myself, but it's just basically marking out these old highs and old lows and trying to figure out where price wants to go to next, right? That's all it is, right? So we push up, we take out all this liquidity there. Boom, we take out all that liquidity. And as you guys can see, this is where we start coming down. We start pulling back to gear up and get ready to attack this next liquidity up here, this last swing point up here, okay? So if I take out all these, right, it's very clear to see that, okay, price is going to come up to here and take that out eventually, right? We're working on our higher low now on the daily chart, okay? And then we come up, we attack it, boom, okay? Now, if we go on the weekly, where's our next drawn liquidity? Up here, obviously, right? These are the last swing highs up here, which it would be right there and right there, okay? This is our next swing point, all right? Our job now, since this structure here has been broken to the upside from this swing high, right? We closed above, we broke structure, we made a higher low right here, a short-term one, and now we're pushing up, right? So where is our next draw going to be? All right, if I start just fast forwarding this, right, we work around here in this range, and then we start pushing up and attack that, okay? So it's basically identifying your liquidity points and then trying to figure out, okay, is price going to come up here? Excuse me. Is price going to go up to there? It most likely will, right? Because this market likes to draw on these stops, on these traders that have profitable positions open, and they have the stops above the swing highs. And again, the swing lows, right? You see price draws down to those lows. They take out traders, then they reverse the market to take out the other stops, right? It's drawing up to those stops to take out traders and bring traders in. It's very, very simple. Drawing liquidity is basically figuring out where price is going to go most likely. All right. And the way you do that is going to be answered in the next video. But that is basically what drawing liquidity is. Just trying to figure out where price is most likely going to go using swing highs and swing lows and relative equal highs, relative equal lows, equal highs, equal lows, etc. Okay. That's how you figure out drawing liquidity. Very, very easy. But sorry, that's not how you figure out drawing liquidity, but this is what drawing liquidity is. We're going to talk about how you figure out drawing liquidity in the next video with displacement in the candles. Okay. So I'll explain that on the next video, but I'll catch you guys then. Peace out.